Hello everyone. So today we'll be doing the counting paper 1, which was written in November 2022. So just to share a little secret with you guys, this is actually the paper that I wrote in my matric in 2022. So I'm so delighted and excited to be doing this paper with you guys. And just to show you how I got through this paper and managed to get a mark just above 90% in my accounting. So it was actually quite a fairly easy paper. If you could only just give me a chance to show you how we are going to ace this paper. All right, so we'll be doing question 1, which talks about company financial statements, aka your comprehensive income, which is your income statement. Then we'll also look at the statement of financial position, which is your balance sheet, right? So as you know, I always emphasize on the marks and the time allocated for a question. Here in this case, we have 60 marks in 45 minutes, right? So the information relates to Lesano Ltd for the financial year ended on 28 February 2022. So this is our financial year end. The financial year end is one of the most important things when you're doing your income statement and balance sheet. So you know how to draw your timeline there, because a timeline is also a necessary tool that you can use when you're doing such questions. Right. So I know there's some stigma behind the income statement and balance sheet that these could be, or possibly the most difficult things that you could come across when you're doing your accounting paper 1. But with acing accounting, of course, nothing is difficult. So let's just get into the required and see what it has in store for us. Right, so refer to information B, that's 1.1, Roman figure 1. Calculate the cost of stock that was damaged. All right, so we're going to go straight into information B, Roman figure 1. There we have stock records. So it says the business sells sports shirts. The weighted average method is used to value shirts, and then the following information was extracted from the records. Now, the first thing that I'm pointing out is that the business uses the weighted average method to value shirts. So at an instant, I just know that I have to use the formula that says total, uh, we say total cost of units, right? Then you would have total units available. Okay, so that's available for sale, right? So this will give you the cost per unit. As soon as you just think of weighted average method, this is what you would need to calculate, right? So now they're just telling us that the business sells sports shirts, right? Then now, looking at what we have on our table there from the records, we have a stock balance on the 1st of March of 1,900 units, and then we have purchases during the year 7,100, and then we have the total available for sale, which is 9,000. So we already have established that we had 9,000 total units available for sale. Then we had a stock balance of 1,185 at the end. Then we sold units worth 7,750. Right, so here we are required to calculate the cost of stock that was damaged. Right, now we have the total. Okay, pardon me, I made a mistake here. So these are the total 9,000 units. Then here we have the stock balance, which or the total available for sale, which is worth 6,579. Right. So now we're just gonna get our cost per unit. The cost per unit being 6,579 divided by 9,000 units, which gives let's see, 7,964. No, let's just make sure the calculation is correct. 65 731. 731. Right, so now we've got our cost per unit at the end. So we have the cost per unit of 731 rands. Right, so now we had a stock balance of 1,185, and we have sold 7,750 units from the total of 9,000 that we had. Let's see if this amount 1,185 is actually correct, right? So we'll take 9,000 units, then we subtract 7,750. Let's see how many units we are supposed to have at the end. Minus 7,750, so that's 1,250. So initially we were supposed to have 1,250 units, but our records say we have 1,185 units on hand. So which means we have a number of units that were damaged. Now, how do we get those? We say 1,250 minus 1,185, which will give 1,250, 1,185. So that's 65 units. So this 65 units that were damaged, each unit is worth 731. So now we'll just go quickly to our answer book. Then we'll say 65 units times 731, which will give 47,515. But remember to show all your workings here. See that how I've placed all my workings all over the question paper. So make sure not to do that. Just show all your workings on your answer book. All right, so let's just do this. It's 9,000, which 731. This is the cost per unit, right? So then how did we determine that there were 65 units? We said 9,000 minus 7,750. Then we had left with 1185. Then it's 1185 minus 1185. Right, then we got 65 units. Then our final answer is 45, 5, oh, it's 47, 515. All right, so this is a loss. Then we are just going to move now to the next question. So we've done this one. Now refer to information B, Roman figure 2. So 1.2.1 says calculate the profit or loss on sale of the delivery vehicle. Then 1.2.2 says calculate the total depreciation for the year. So we'll start with this one. We are going to calculate the profit loss on the sale of the vehicle. All right, so information B, Roman figure 2, we are just going to look at the vehicles. Now it says vehicles are depreciated at 20% on a diminishing balance. Then the bookkeeper calculated the total depreciation as 32,000 or 328,200 before taking the following into account. So what affects vehicles is just this statement. Let me actually just highlight. We have 20% per annum on the diminishing balance right there. Now, an old vehicle, delivery vehicle with a carrying value of 170,000 on 1 March 2021 was sold for 140,000 on 1 December 2021. So it was sold on 1 December 2021. Then this is our opening. Remember, this is our opening balance. The 170,000 is our opening balance. So because on the 1st of March, that was the start of our financial year, since it ended on the 28th of February 2022. Right, so now when we look at this, they said depreciation occurs on our diminishing balance method. Right, so this year we haven't used the vehicle for a full year. We only used it until December. So we need to depreciate for the number of months that we have used the vehicle. So we just quickly draw our timeline. I'll just do it around about here. All right. So I have the 1st of March, of April, May, June, July, August, September, October, November, December. Okay, let me just add there. December, Jan, then I have Feb. Right, so we started using it here on the 1st of March. We include March because it was used also in March, April, May, June, July, August, September, October, November, December. But is it correct to add December here? No, because they said on the 1st of December, which simply means we've used it until the end of November, right? So we are just going to remove December and only count until the end of November. Because if they say the 1st of December, that means we haven't used it for the month of December. So it would be incorrect to include it for the month of December. So now we're just going to count 1, 2, 3, 4, 5, 6, 7, 8, 9 months. So it was used for 9 out of the 12 months, right? So let's just first calculate the depreciation. We're just going to say 170K multiplied by 20% multiplied by 9 over 12. Right, so it's 170 times 20% times 9 over 12 months. So 12, which is 25,500. Right. So now to get the carrying amount at date of disposal, it will be 170,000. This is our opening balance, or we could say opening carrying amount, minus the current year's depreciation of 25,500. Right, so 170 minus 25,500, which is 144,500. Right. Remember, we're calculating the profit or loss. We still haven't answered the required. How much did they sell it for? They sold it for 140,000, right? So this was its carrying amount, the 144, and then they sold it at a price that is less than the carrying amount, which means they have made a loss there. So it's 140,000. So that's a loss of 4,500 loss. Right, so that's a loss of 4,500. Just say loss on sale. Right, so that is your calculation there. Then we are going to calculate the total depreciation. So the depreciation on vehicles sold, we already have it. We calculated it as 25,500. We calculated, and then now we are supposed to calculate the depreciation on alarm system. So just go to our information B Roman figure 2 there. And then now we're just going to quickly look at equipment. So it says equipment is depreciated at 15% per annum on cost, right? Then now we have been told that this has already been included, that the only depreciation that we just supposed to calculate is on the alarm system that was installed on the 1st of August 2021. Remember, we've only used it from August until the end of the financial year. Don't be confused by the dates. So now we're just going to go back quickly to our timeline there just to get the workings again. All right. So now it was bought for 48,000. Then we used it from the 1st of August, right? I'm including August in this case because we've used it from August up until February. So we have 1, 2, 3, 4, 5, 6, 7 months. All right. So we've used it for 7 over 12 months. All right. So the depreciation is 15% on cost. So we'll just say 15% multiplied by 48,000 multiplied by 7 over 12 months. Right. So let's just quickly see what that will give us. 15%. And right, so that gives 4,200. Okay. So now let's just simply add these numbers. 328,200 plus 25, 500 plus 4,200 will just be 357,900. Right. So that is your depreciation for the current year. Then we are moving on, of course, to the next question, which requires us to calculate and complete the following for the financial year 28 February 2022. Right. So the first one is the statement of comprehensive income, your income statement. Then the last one is your equities and liabilities section of the statement of financial position. So information A, because we haven't gone through it and we should go through it now, it just gives us the extract of balances and totals from the records at the year end. And then information B, of course, we've already gone through it. But remember that everything that we have calculated, we have to consider it in our income statement, such as the loss that we have incurred on our trading stock, the depreciation that we have calculated for the year, and also considering the information that follows here. But what I like to do first is to consider what I've calculated first and just put it on the income statement just before we forget about the rest of the information, right? So the first thing that we calculated, we had our trading stock deficit, or you could say loss on trading stock. All right. So it's really important to take your amounts anytime or every time you calculate, even if they're incorrect, just take them as they are and put them here. You will get some method marks. Right. So we calculated our loss as 47,515. So just plug it here, 47,515. Right. Then we also calculated the depreciation expense. We calculated depreciation of that was 357,900. Then we had a loss on sale of asset, right, of 4,000. Was it 4,500? Let's see. Yes, I had a loss on sale of assets of 4,500 there. All right, let's just do this. Right, so now we are just going to move on to our income statement here and see what we can do. Right, so we are going to consider information B, Roman figure 3, right, because we already have dealt with everything that is above here. Now 33,700 was received from a debtor whose account was previously written off as irrecoverable, was posted in error to the debtor's control account. This must be corrected. So how do we interpret this? First thing that we are supposed to understand, that we have received 33,000 from a debtor which was previously written off. So this means that this person was a bad debt. Right, that's the first thing that you have to understand. And remember that every time you receive an amount from a bad debt, it's supposed to be recorded as bad debt recovered. Right, so if it's a bad debt recovered and they posted it in error to the debtor's control account, which means this has had an impact on our on our debtor's control account, right? So now what we need to do is just add back the 33,700 on our debtors control account. Then we correctly record it to 32 to bad debts recovered, right? So on our income statement, we'll just say bad debts recovered. It was 33,700. Then now we have to adjust our debtors control because it was reduced by 33,700. Right, so our debtors control, why do I keep on saying bad debts? All right, so we have our debtors control. Let me just highlight it there. This is our debtors control. So it's 2,746,300. All right, so we're just gonna add back the 33. So it is 2,746,300 plus the 33,700. Let's just see what that gives us. So that is 2,780,000. Right. Now we have corrected this error, and then they say the provision for bad debts must then be adjusted to 3% of the debtor's control balance. So our provision for bad debts, it must be adjusted to 3%. So we'll calculate 3% of this amount that is adjusted, not the incorrect amount that is in our extract. Right. So the provision for bad debts in this case will be 83,400 for the current year. Now remember that we have to adjust for our provision for bad debts. Now we have to compare it with last year's provision. We should determine if it is an increase or a decrease. Please listen to me carefully now. If we have a decrease in our provision for bad debts, it is income. If we have a decrease, if you have an increase, it is an expense. Right. So I hope that was just clear. If it wasn't clear enough, just don't be shy to rewind the video and listen to what I said again. Right. So in the previous year, we had provision for bad debts of 85,840. Right. And this year we had 83,400. Right. So it's a decrease, hence it's an income, because now we are not providing for more. I don't want you to cram, but I just want you to understand why is it a decrease and why is it an income. So because this year we are providing for less, which means last year we had recognized a huge expense. So now we have to decrease that expense by recognizing what? An income. Right. I hope that was clear again. So now, how much income do we have from this adjustment? So we'll just say 85,400, 85,840. Beg your pardon. Then it's 83,400. Right. So let's just see how much of an income we have made there. So that is 2,440. Right. So that goes there. Provision for bad debts adjustment. Provision for bad debts adjustment, because it's an income. Remember, we're recording it on other income. Then it's 2,440. Right. Then now we are just going to move to another point that we have here. Now, the business signed a contract with Always Safe Securities for guarding the premises. An annual premium of 32,400 for the period ended 31 July was paid in full on the 1st of August 2021. So this is another one that requires us to use our timeline again. So let's just quickly do this. Remember, we are using the accrual basis. So in the income statement, we only want to record what is relevant for this current financial year. So whatever was utilized outside, we are not going to include it, right? So the annual premium was 32,400. We want to determine how much of that annual premium relates to the current financial year, right? So we paid from on the 1st of August. We utilized it for August, September, October, November, December, January, February. But remember that we have included everything, even the number of months that we have that are not relevant for this part for this current financial year. So now what we need to do is just remove all those months. Now, how many months have we used it for this year? 1, 2, 3, 4, 5, 6, 7. Right, which means it's an annual premium. It is for 12 months. Now, for the rest of the months, it's 12 minus 7. We have used it for 7 months. That's fine. We've already included it. Now, the 5 months that are out, we need to subtract them. So it's 5 over 12. Right, so it's now 32,400 multiplied by 5 months over 12. The 5 months that we haven't used. Right, so it's 32,400 times 5 over 12, which is 13,500. Right. So now let's just go see our security there. And security expense. Alright, so securities expenses. It was 72,500, and just we are going to remove 13,500. Alright. So here we have an expense of security expense. Then it was 72,000. Was it 72,500? Alright, please just be patient with me. These numbers are just playing in my mind. So that's 72,500. Alright, 500 minus 13,500. Then we have an expense of 59,000 as our security expenses. Right. Then now, please ensure that you show all your calculations. I highly recommend that you show your calculations in this space every time, all the space that I'm highlighting for you. Please just make sure that you show your calculations there, and show what you're actually calculating. Let's say maybe you're calculating, let's say you were calculating the security expenses, even if it's not that neat, because of course we're fighting against time. So you could just do your calculations quickly here, do your calculations, and then the marker could see that even if you get an amount incorrectly, they could still award you with marks. So it's very, very easy to pass accounting, even if your balance sheet or income statement doesn't correctly align with the memo 100%. So now, what we need to look at again is our Roman figure 5, which says all details in respect of the February 2022 salary of an employee were incorrectly debited to the sundry expenses account. Now, the following information relates to his salary. So they forgot to, no, not necessarily forgot, but they debited this person's salary to an incorrect account. So we just need to add back the gross salary to the salaries and wages account, right? So remember that the expense to business is the gross salary, right? Now, what builds up the gross salary? It's the net salary plus any deductions, So the expense to the business is the gross salary. So our aim or purpose is to just add any um any deductions and the net salary. So I forgot one last thing, plus any contributions. All right, plus any contributions. Sorry there. So it's just these three things that build up our gross salary, right? Now, when we just go to look at our information there, we have a net salary of 11,525. We have the SARS pay as you earn tax, and then we have the pension fund. Now, the business contributes 2 rands for 1 rand deducted for the pension fund. Right, so this is also what we need to consider because these are contributions. So let's just see what total amount we have for salaries and wages. Let me just use a different highlighter. So for salaries and wages, we have, there's so many amounts. So we have salaries and wages here. So 1,381,500. So let's just quickly go to our income statement there. So salaries and wages. All right, 1,381,500 plus we're adding to the salaries balance that we were given. We are adding 11,525. We are adding 3,225. We're also adding 990 plus we are adding 990 multiplied by 2 because they contribute 2 rands for every 1 rand deducted for the pension fund. So they're contributing 2 rands for every 1 rand. How many 1 rands are here? 990. but they're contributing 2 rands for this one for 990 rands. All right, so we are going to add all of these. All right, so this is 3235. My bad, 3235. So it's 11,525, 3235 plus 990, or 11,525 plus 3235 plus 990 plus 1980. So be careful when you're punching your calculator there, because it just can get a bit messy. So we are going to just write them individually. So that's 11,525 plus 990. Oops, I don't have much space. Let me just say 17,730. So let's just add that and see it's 1381, 17,730, and that gives 139,930. Right, so we've dealt with salaries and wages. Be careful when you're calculating a long string of numbers. Just be sure that you get all of the numbers correctly there when you type in your calculator, because you could just be making a minor error whereas you got all of the numbers correct. So our EFT payments have already been processed for all relevant amounts payable, so that's considered as payment. Now Roman figure 6 says a tenant has been leasing office space on the premises since March 2020. She has paid the rent until 30 April 2022. Note that the monthly rental amount was reduced by 1,250 with effect from 1 January 2022. I know this type of question might be a trauma to some of you, but let's just break it down here. Right, okay, I've got some space here. I just want to have a timeline here. So we have March, April, May, June, July, August, September, October, November, December, Jan, Feb. Right. So we have that. Right. So now we have some information here. It says a tenant has been leasing the space since March 2020. All right. Now they've paid their rent until 30 April 2022. So they've paid way above our financial year. So we have Feb. Okay, let me just try to use a different color. So these months are out of our financial year: Feb, March, April. So they paid 2 months in advance. They've already paid for the 12 months here. So they've already paid the 12 months. In total, they've paid 14 months. 14 months paid. Right. So we know that from our balances here, with our rent income. So our rent income relates to 14 months. That's what we know now. Relates to 14 months, right, from our timeline. That's what we've just deduced. So, okay, this is March, April. Right. So they said she has paid, okay, until 30 April 2022, and then the monthly amount was reduced by 1,350 with effect from 1 Jan 2022. It was reduced by 1,350, right, from 1 Jan 2022. So from here, minus 1,350, minus 1,350, minus 1,350. So this is for March, Feb, Jan, and April, minus 1,350. So now the first thing that you would need to calculate is the monthly rental amount, right? We want to see how much does this person pay per month. But because we don't know any of the two amounts, we just want to first reverse the effect of the reduction in the rent amount. We're just going to say 1,350 minus or multiplied by 4, right? So it's 1,350 times 4, so that's a difference of 5,400. right, from the previous monthly rental, right? Now, this person has paid a total of 183,600. It's 183,600. Right, so was my working? So 183,600. The 183,600 already has accounted for these decreases. So now, because we want to see how much was the rent, the monthly rental, before the decrease. So now we'll just simply add back the total decrease of 5,400, which amounts to so 1,18900. So if there was no decrease, if there was no decrease. So if there was no decrease in the monthly rental, this person would have been paying 189,000, would have paid a total of 189,000. Remember, this is for 14 months, right? Now we want to check how much is the monthly payment. 189,000. How much would have been the monthly payment for the 14 months? Right. So it's 189 divided by 14 months. So that's 1,000, what's 13,500 per month. Per month before decrease. Before the decrease. Now after the decrease, we had 13,500 and it decreased by 1,350 per month. Right. So now the current rent is, well, okay, let's see. So that's 12,150. Right. So why do I have two R's there? So it's 12,150. That's the current rent. Right. Now we have paid, or this tenant has paid us 2 months in advance. Remember, now we have to consider that fact, the fact that this person has paid us 2 months in advance. So we're just going to say, because we have received 183,600, but this person has paid us 2 months in advance, because what's the current rent amount is 12,150 multiplied by 2 months in advance. Then we have minus 12, 150 times 2, we have 159,300. Right. So that's our working for the rent income. I hope that was pretty clear. Right. So for our rent income, oh, our answer book is this way. So here we have the rent income as 159. So 159 300. Right. So it's 159 300. Right. Then we move on again to income tax. They say income tax for the year is calculated at 30% of the net profit. The net profit after tax is 356 300. Right. So now when we're looking at our net profit, it is our income tax is 30% of the, okay, so this would be the net profit before tax. We know this is always 100%. We've just been told this takes 30%. Then our net profit after tax is 356 300. This would take up 70%. Right, so we are just going piece by piece, and with the information that we're given, of course, we'll just simply work from our top, from our bottom up. Right, so now they said income tax will be 30%. Of course, that's what we want, but what we know, we have 70, so it's what we want over what we know, because we have the net profit after tax, which constitutes of 70%. Then here we're using what we want over what we know multiplied by the amount, 356 300. And then let's see our income tax there, 70 times 356 300, then it's 152,700. Right. So it's 152,700, remember, in brackets. And you can just simply add these two to get your net profit before tax, because it's 100%. So it's 509. So it's 509. Right. So we could then also calculate the profit before interest expense. By doing so, we'll just add interest expense and the net profit before tax. So let's just see if that works for us. 250. So, but before, let's just wait and see. Plus 509. Okay, so that's 651,250. Because remember, to get your net profit before tax, you take your profit before interest expense, you minus interest expense, and then you can get this line item. But in this case, we were just given one amount, and then we calculated this one. Then we were working in reverse there. Right, so let's just make sure this is nice and neat. So it's 651,250. Right. So also interest income, it could be a figure that we would have, because you know that you take this amount, you add interest income, and then you get this one. Right. So this was fairly an easy calculation. 651,250 minus 575. So that would give 76,250. Right. So we're done with our bottom part there. So now, what we just need to check is that all of our information that we have considered is accurate and definitely correct. So, okay, we have a loan there, we have shares and dividends, and then we have our net asset value per share. So, I suggest that would work in our equities and liabilities section. But as far as I'm concerned, we are done with our income statement. So I just suggest that we now add up our numbers and see if they are accurate. All right, so that's 33. We'll start by adding our we're calculating our other income. So we'll just add those amounts and see what we get there. So okay, that's 159,300. Then let's just quickly see. I'm getting an answer of 200,000 there. Then we add, of course, our gross profit and other income. So that just gives 389,890. Right. Then now we get to our operating expenses. Right. But before we calculate operating expenses, you can definitely see that we have sundry expenses there, and our sundry expenses are not complete, of course. So what you could do is calculate your sundry expenses as a balancing figure. So now what we have is our operating profit, right? So using our operating profit, we can calculate our operating expenses here by taking the gross operating income, then we subtract our operating profit. So we'll say 3890 minus 575. Then our operating expenses is 3315,123. So just to ensure that your calculation is indeed correct, you can just do the reverse calculation again. Take this one, subtract this one, then see if you could get this amount, right? And if you're also comfortable with working with solve for X, you can also match as well. Just do that if the calculations confuse you. Right, so now that we have got our operating expenses, you know that to get to this amount, we are supposed to add all of these amounts, right? So now we're just going to simply take this amount, because it's the total, subtract all of these one by one, so that we could get what figure is actually missing here. Right, so now we're going to take the 3,315, then minus 1,124. Okay, let me just do this quickly. 15357,900 minus 4,500 I hope you're also punching your calculator so you can see that we get to the correct solution together. Right, so I'm getting sundry expenses of 239,855. Right, so just to ensure that the calculation is correct and the numbers are correct, yes. So that's 239,855. I assure you, I punched all my numbers correctly there. I punched all my numbers correctly in my calculator. Right, so I could confidently say that we are done with the statement of comprehensive income. Don't be alarmed by the spaces that you could see here. Sometimes Vele they could give your income statement with extra spaces just to trick you. But just make sure that you know all the principles that you need to know. Ensure that you understand everything that you need to understand, and ensure that you account for all the amounts that you are given and all the calculations that you're required to calculate. Right, so now we're just going to quickly move to our extract of the statement of financial position. What I like to do here with the equity and liabilities, I just like to quickly populate my my what's the statement of financial position. Right, so here you would have a loan. That's the first thing. And then you would also have, if you have a loan, you have the current portion of loan. Then you would have shareholders for dividends. Right, so we'd have shareholders for dividends, and we've had SARS, I have taxation, of course. Right, and then the rest of the things you would get from your information, but these are the key I wouldn't say three things in your current liabilities, but just these are the almost the basic things that they would ask you to calculate. So for the sake of time being, just make sure that you always know these, and you just populate your statement of financial position in an instant. Then our ordinary shareholders equity, it is formed by our ordinary share capital and our retained income. You could say retained income or retained earnings. Right, let me just say retained income for sake. Then now we consider our information. So we have our loan, we have our shares and dividends there. We have also our net asset value per share that we are supposed to consider. So the loan information says all transactions with respect to the loan were recorded, and then interest of 142,250 on the loan is capitalized. All right, so this is our interest that we have seen in our statement of comprehensive income. Then a fixed monthly installment, including interest, was paid in full. All right. Now, the capital portion of the repayment will increase by 10% over the next financial year. All right. So to see how much we have paid on our loan, we are just going to go to our loan amount. All right. So our loan amount here from certain bank is, let me just use a different highlighter. It's 1,159,000 in this current year. That's the ending balance, and then we opened with the balance of 1,287,50. Just before I forget these numbers, I'll just quickly do my calculation here. It's 1,287,50 minus 1,159. Then let's see how much we have decreased our loan by. All right, 750 minus 1,159. So that's 121,750. So we have decreased our loan by 121,750. Now, when we look at this information, they say it will increase by 10%. Remember that this includes our interest payment, includes say interest. So includes interest because we've already paid interest here. Now it's 121,750, and then they say it will increase by 10% multiplied by 110%. Right? Or you could just say multiplied by 1.1. So it's 121,750 times 110%. So what we'll pay next year is 133925. Right. So in one of my videos, somebody asked me, why are we multiplying it by 110% and why are we adding it to our current liabilities? So this is just to make sure that we account for, remember that for current liabilities, it's liabilities that are 12 months or less. It's liabilities that we might settle in the next financial year. So the current portion of the loan, because we'll settle it next year, it becomes current. So also the 110% is just to account for the 10% increase, right? So now the 12 months or less, it's your current liabilities. Then if we're going to pay it next year, then we of course move it to the current portion of the loan. So our answer there was 133925. Okay, let me just remove the currency. Okay, then that's for our current portion of the loan. But now we're not done. So the capital portion of the repayment will increase. Okay, we're done with that. But now we need to see how much is actually our loan amount, our principal loan amount. So we have 1,159,000. So it's 1,159 at the end of the year, minus what are we going to pay next year? We are going to pay 133925. Then we will be left with loan amount, principal amount of 925. So that will be 12025,075. Right. So we have our loan there. Let's just show our calculation here. Also, that's 1159 minus 133925. And how did we get one? So we had this. It's 1025075. Right. Ensure that you always show your calculations, even your calculation that we did here for the current portion of the loan. Then we just quickly go through shares and dividends. So on 28 February 2022, there were 1,150,000 shares in issue. So it's 1,150,000 shares in issue. That's the end of the year. At the end of the year, this is how many shares we had in issue. Right. Okay. Then a final dividend was declared on 28 February 2022 at year end. Now total dividends for the year amounted to 345,000. Right. So of course we have declared it at the end of the year, which simply alarms that we haven't made any payment. We have no payment, no payment. Right. These are total dividends, and when we talk about total dividends, it includes interim and final. Right. So we need to remove the interim dividends there just to see how many shares, or how many dividends rather, were issued were declared at the end of the year. All right. So we have interim dividends at the end here. I don't know if you could see them. We have dividends on ordinary shares, interim of 20700. So now we go here. So it's 345 minus 207,000, which gives, let's see, so 138,000 of shares that were not paid. So that is shareholders for dividends. So shareholders for dividends of 138,000. Right. Then we go to our final one, which says net asset value per share. After taking into account all adjustments, the net asset value per share, or the net asset value per se, was correctly calculated as 675 cents per share. Remember that your net asset value per share, you have your shareholders' equity, shareholders equity over the number of shares in issue. Right, number of shares in issue, they told us it was 1,150,000. Then shareholders equity, we are going to determine that, right? Because we're given the net asset value per share. Right, so it is, okay, let's just say 6.75 cents. Let's just change that to rands. 6.75 is equal to your shareholders equity. We'll just say it's X because that's what we're solving for. We don't know. Then our number of shares that are in issue. Okay, so I have 6.75 multiplied by 150. Then that gives us 7 million. X is equal to 7,762,500. Right, so this is our net asset value. This is our shareholders equity. And then this is our number of shares in issue. Right, so this is our shareholders equity. So our shareholders equity here, it's 7,762,500. And that way we can calculate our retained income. We could just say 7,762,500 minus 6,670,000. So it's 6,762,500 minus 6,670, and our retained income will be 1,092,500. Right, so I was just showing the calculation there. Then now what we are left with here is nothing, but not nothing at all, because we still have to account for our SARS income, and then we also need to account for our trade and other payables. As you know that we have trade and other payables on our current liability, so we'll have trade and other payables there. Right, so our SARS taxation, we're just going to look at our income tax of 152,700. That's what we're supposed to actually pay to SARS this year. And then let's see how much we've actually paid in order to determine our current liability. So to SARS, we have made provisional payments of 130,000, right? So we have paid 130, but we're supposed to pay an amount of was our income statement 152,700. So 152,700 minus 130 will give us 152. So that gives a liability of 22,700. Right, so that's 22,700. Now then we go to our rent income. I don't know whether you remember our rent income. What's this adjustment? Remember that we have received income in advance. So income that we have received in advance will be a current liability because we haven't actually earned that money, we've just received it. So now it's the 13,500 that we have. Oh, not actually the 13,500. So it's the, what's this amount? It's 12,150. I actually didn't calculate it, times 2, which we received in advance. So that's 24,300. Right, so I just want to make sure that it's correct. It's 12,150 times 2. Yes, so the 24,300 is a current liability because it's an income received in advance. So it's 2,4,300 plus, let's just make sure that we don't have any other trade and other payables on our amounts there. So trade and other payables, let's see. So we have sales, cost of sales, audit fees, commission. Oh yeah, got it. So we have creditors control there of 428, because remember, creditors control are part of our trade and other payables. All right, okay, so that's 428. Oh, 428,000. Right, so it's 24,300 plus 428, and that's 4,52300. Right, so that looks like we have everything we needed to encounter. So we could just quickly calculate our totals and see what we have. Right, so our non-current liabilities, we just have the 1025075. Then we already have our ordinary share equity. Then we will just add our current liabilities, 138 plus 22700 plus 452,300, and then that gives a total of 746,925. Oh, this is actually supposed to go down here. No, it's actually correct. Then we are going to add everything else, and then we bring it down here. Almost made a mistake there. So we add all of those. Then okay, 7762500. Then that gives us 9534,500. Right, so that is just how we go about our extract of the balance sheet and our income statement. I hope this video has been helpful. I hope it will just enlighten you on how to work on different questions regarding the income statement and the statement of financial position. Otherwise, don't forget to subscribe, comment, like, and of course share with anyone else who would like to ace accounting with us. And from me to you, good luck with your tests and exams. I'll definitely see you in the next video. Cheers.